welcome to another edition of Ironwood's Quarterly Markets Insights webinar. We sincerely thank you for joining us tonight. My name is Preston Morris, and I'm excited to present Rex Weeks, who will be presenting tonight's webinar. Rex serves as Portfolio Manager at Ironwood and is a holder of the Chartered Financial Analyst designation. We do welcome questions, but ask that you please type them into the GoToMeeting box, and we will field them at the end. With that, I'll pass it to Rex.
Thanks, Preston, and thank you everyone for taking time out of your schedule to join us tonight. Sure, a lot of people are there getting back in the swing of things after summer, getting the kids back into school, so I appreciate you taking time out of your busy day. We do have a lot to go over, but hopefully we can get through it pretty succinctly and efficiently. The agenda for tonight, I'll start by going over some events that Ironwood's having in the second half of this year. We'll go into economic data from Q2, review GDP and the consumer, and then we'll give updates on debt and the one big beautiful bill, tariff update on Fed inflation and interest rates, and then review earnings and valuations. So we have our annual golf tournament, the 16th annual, that is coming up on September 25th. That's a Thursday at Raven Golf Club. The first round of invites were sent on August 1st, so please check your inbox if you haven't seen those yet. And then remember that RSVP are due by Wednesday, September 10th. Also, kind of other side of the coin, we do a Feed My Starving Children event where we pack boxes of food for the less fortunate. You can come join us for a meaningful afternoon of giving back. It's on December 5th from 2:30 to 4. We'll have a happy hour immediately after. The location will be announced once that invitation registration email goes out in October. So please keep an eye out for that as well. And then we'll jump into the fun stuff. So Q2 2025 economic data. So first, starting off, the 10-year Treasury rate is currently sitting at 4.22. It was 4.58 at the beginning of the year. That's a drop in about 36 basis points. ISM manufacturing posted 48.5, 49, and 48 in May, June, July, respectively. That's all below the 50% that we kind of have as a line in the sand showing that reading is in contraction. The more important to the U.S. economy is the ISM non-manufacturing number or services. That also dipped below 50 and then bumped back up in June and July. And then on the job side, we added an average of 35,000 jobs in each of the last 3 months, with May and June being revised substantially lower, 258,000 total. And then employment ticked up and it's actually to 4.4%. Real GDP growth was 3% in Q2, reversing that trend in Q1. We had a negative 0.5% reading, mostly because companies got in front of those tariffs with their acceleration of imports. And then Atlanta GP now is forecasting a 2.1% growth for Q3 of 2025. Components of GDP, you can see that GDP began to slow last year. It was at 3.1% in Q3 and then dropped down to 2.4%. It's a substantial drop, but we've seen some accelerated growth with all of the AI spending that's been going on. The 2.4 is still above that 2.1% trend growth that we've seen since 2001. The continuation of this trend, though, is what is starting to spook some people. Although we don't want to look at one data point, the negative 0.5 in Q1 or the 3%, excuse me, in Q2 alone, that average rate is a 1.25% growth through the first half of 2025. This is obviously below the trend and definitely troubling if it continues to slow and becomes negative, which signals a recession. Consumption made up 68% of GDP last quarter. It just shows the heavy weighting that spending and health of the consumer has, and how important it is to the growth of the US economy overall. And then this kind of helps us, like I said, we want to look at it over a longer period of time to kind of look at the trend instead of one point. Could be misled, like I said, if you look at just Q1, we've got a negative reading. Q2, we've got a positive reading above trend. But when you break it down and you compare this quarter to the average over the last 24 years, you can see that this important, I just said consumption makes up 68% of GDP. Well, the percent contribution is 1.7 over the last 24 years, and that dropped to 1% in Q2. So the most important part of GDP, or what makes up GDP, has been dropping and continues to fall. Could see it tick back up after the tariff uncertainty lifts. That's definitely had an impact, and we could see a large boost to it in the first quarter of next year with the larger tax refunds that people will see from the regulation that it was recently passed. Confidence is key, like we just stressed over the last two slides. The consumer is a huge part of the U.S. economy, so it's important that people are, they're feeling good about where they're at in their job. They're feeling good with how much they have in their bank account, feeling good with their investments, because then they're going to continue to spend and continue to boost the economy. It's kind of like a self-fulfilling, prophecy. When people freak out about the economy, they hold back, they save more, they don't spend, and then GDP falls. So it's important that we have confidence here. And as you can see now, we always kind of joke, if you had a crystal ball and you could invest at each of these lows, the last one being in July 2025, and kind of, invest all your money there, you'd probably be the most successful investor on the planet. But going deeper into the health of the consumer, as you can see, asset levels are extremely strong compared to liabilities. Some of this, it's been this way for a while, but a big boost happened during COVID when we had these stimulus checks, and the run that the stock market's been on since then has definitely helped people's financial accounts as well. The household debt to service ratio has come up a little bit over the last few years, but it's still in line with pre-COVID levels. So, no flashing signals there. And then the flows into early delinquencies, same thing. Obviously, the orange line is a little alarming, or seems to be, but this is pointing out student loans. And, there's been back and forth recently. After COVID, they said they were going to, forgive all student loans. So then obviously it's where that dip came in, and it stayed that way for a little, but then the Trump administration has recently kind of kicked the collection efforts back into gear. But again, if you extend this line from when they were forgiven to this current point, it's back in line with COVID levels. So nothing that should be alarming us as of yet. And then looking into the Fed and its finances, the amount of debt the U.S. has to issue to fund spending continues to grow as spending increases. So this box here makes up the difference between what the government spends and what they collect in the form of mainly taxes. So that's what makes up our deficit. Not only does it continue to grow, but it continues to accelerate. We're passing bills that increase spending, that raise the debt ceiling. Social Security and Medicare are part of spending, and those are only going to increase, especially as a large portion of our population exits the workforce. So the deficit and net interest payments are both projected to rise, as you can see on these two charts here on the right. As they were before the One Big Beautiful Bill Act was passed, and then with this red line, you can see they're even projected to grow higher and quicker. So like we've said, and like we'll continue to say, the deficit is definitely something that needs to be top of mind for the U.S. government and for investors. This just kind of another illustration of what I just said. So the lower point is the beginning, June 2nd, 2023, when the debt ceiling was lifted, and through end of June of this year. So a little over 2 years, the debt increased by 4.75 trillion. I know it's beating a dead horse, but this is something that needs to be addressed sooner rather than later. The caveat here, the tricky thing is that because the people who are in charge of fixing this, politicians, not to get political, but politicians are in charge of fixing this, and they're trying to get reelected, and nobody's really going to reelect somebody that their main goal is raise taxes, which is one big thing that would have to happen to really put a dent on this trajectory, this path that we're going down. So that'll have to be sorted out in the near future as well. And then diving deeper into, I mentioned the One Big Beautiful Bill Act, how it's going to affect our deficit and the interest that we pay on this deficit. I just wanted to give a little recap of some of the high level. It is big. There's a lot in there. I just wanted to high level go over some things that it impacts. The first being taxes. So it extends the 2017 Trump tax cuts and introduces new tax breaks. It also raises the SALT deduction cap to $40,000 for a 5-year period for households earning more than $500,000. Obviously, this lowers tax revenue. The other side, it should increase spending by putting more money into people's pockets. But as I mentioned, this is good for growth, good for spending, but at the same time, we could see an uptick in inflation as well. Second, healthcare cuts to Medicaid, and it establishes, or it's estimated that these cuts could lead to millions of Americans losing coverage. It also establishes a couple of new programs that are kind of looking to reform Medicaid. 3, student loans, reform student loan system and reduces payment plans to 2 options. And like I mentioned, that delinquency rate is kicked up because they've people need to start making payments again on their student loans. And then finally, immigration and border security, funding for ICE and CBP, which is Customs and Border Protection, to support immigration enforcement and overall border security. So that funds the border wall, detention capacity, and funding for security personnel. And you can also check your inboxes. I believe 2 weeks ago, within the last month, we sent out kind of a catch-all that goes into the One Big Beautiful Bill in more detail. So with all that I mentioned, and obviously a lot of smaller stuff within the bill, but the big one is the spending increase and the cuts to taxes. So the annual change in the deficit, as you can see, is projected here, is billions added to the debt because of the One Big Beautiful Bill Act. The difference between these 2 shades, so the blue is as it's written currently, and then this hash mark orange-white section is if it's made permanent. And basically what that means, it's kind of like think of the blue were the prior Trump tax cuts, and then this on top was the One Big Beautiful Bill. So the One Big Beautiful Bill has an end date theoretically, but a lot of these things end up getting, once they come due, they end up getting extended. And if that happens, we would realize these top lines added to the debt every year. So if the temporary remains temporary, we'd add about 4.1 trillion to the debt over the next decade. And if the temporary portion becomes permanent, we'd add 5.5 trillion debt over to the deficit over the next decade. So either way you slice it, again, it just makes this problem even bigger. And then, like I mentioned, not only are you increasing the debt, but you're increasing the interest costs on these elevated debt levels, it's projected that it'd add just $1 trillion in just interest costs alone through 2034. The interest on our debt is currently at 3% of GDP, but it's projected that with all these changes, it could double to 6% by 2050. And then again, this just kind of simplifies the theme that I've been talking about. Spending has continued to grow over the years. Tax revenue, as you can see, it's since about beginning of 2023 has been rising, just at a slower rate. So in a perfect world, we would want these to start to converge, or at least for the tax revenue to grow at a faster rate than the government spending, so that we could start cutting into this deficit instead of it just growing and us paying more and more in interest as well. So a couple solutions that everyone throws around or talks about. It's either we can solve faster growth, which I think is top of people's mind with all the AI that's going on. Obviously, we'd get more productive. We'd grow faster, so we'd cut down on business expenses while increasing revenue. So that would be good for growth. 2, raise taxes, which I talked about. Almost nobody wants that. And then we just lowered them in the One Big Beautiful Bill, so we're going the opposite way there. 3, cut spending. Again, U.S. spends a lot of money, and spending increases every year and accelerates. And like I said, we have some things coming down the pipe with a large portion of people retiring, increasing the Social Security and Medicare costs. And then 4, lowering rates, which again could cause inflation. And 10-year rates, as we've seen, may not follow the short end of the curve when the Fed cuts. So it may be a moot point as well. So there are a couple options. Could be a combination of them, but again, it will need to be addressed soon. And then, as I mentioned on the summary slide, this is just a tracker of US ISM service versus US ISM manufacturing. Like I said, the manufacturing line has been in contraction territory below this 50% line for a majority of readings. The one that we're concerned most about is the services line. Ever since it's been a trend for a while, but ever since COVID, really, services has taken a majority of the weight in what makes up our economy. It's actually up to about 70% of the U.S. economy. So it dipping below 50, obviously, like I said, one piece of data is a point, 2 pieces is a line, and 3 is a trend. So we want to, although one point might get your attention, you really want to look at trends. So we're dancing close to this line. If we start to see a decline, it could have an extremely negative impact on our growth in our economy, because again, that's 70% of what we see. Next, we'll quickly go through some tariff updates. This is, as most of you know, it's ever changing. We get new tariffs. It seems like every day now we get tariffs taken away, levels increased. President Trump signed an executive order adjusting reciprocal tariffs for a large range of countries from anywhere from 10 to 41%. I believe the EU was a blanket of 10%, and then based off of our trade deficit with certain countries, it may have added a reciprocal tariff on top of that. 3 of our 5 largest trading partners have yet to sign a deal. So we got EU and Japan all ironed out, but China, Canada, and Mexico are still outstanding. China is really the last big domino to fall. Although Canada and Mexico, we do have a lot of trade with them. We already have the USMCA agreement in place, which is basically a trade agreement between North America countries. So it basically says, if 60% of inputs or parts of a good are made within North America, then it's exempt from any tariffs. So the tariff rates that end up, being levied on Canada and Mexico may not impact the overall effective tariff rate that much. So, and that China keeps getting extended, keeps getting kicked out as Trump continues to negotiate with them. And main takeaways, like I just said, negotiation tool has been kind of the calling card for the Trump administration ever since Liberation Day, when those crazy high tariffs were announced. We started to see some signs that it could be slowing the economy and leading to higher inflation. Again, it's just been a couple data points, and we want to wait for trends to really see if it's having an impact. And then longer term, and what the administration really wants is the possibility of reshoring. So as I mentioned, manufacturing has kind of taken a backseat to services in our economy. We offshore factories, a lot of the things you see, shirts, toys, they say made in Taiwan, made in China. So they're trying to get those manufacturing plants back over here. Obviously, that would be great for U.S. growth, great for the job market, job creation. But it's going to take some time. And in the medium term, it could have a negative impact on the consumer or on company profit margins, which we'll get into in a little bit. This just shows, so the average tariff rate on U.S. good imports, as I said, this April 8th peak on Liberation Day was at 30%. That's when we had that sharp decline in the market. As of this ended day yesterday, I think he placed another 25% on India today, so this might be a little higher, but we haven't seen this high of a statutory tariff rate since 1939. So it's definitely going to have some impact. The question that everyone's trying to figure out is where is it going to be seen? Is it going to be seen the consumer side, higher prices, higher inflation, or is it going to be seen on the company side with tighter margins and lower profit? Next, we'll go into Fed, inflation, and interest rates, and the relationship between all three. So, as I mentioned, you see the inflation reading started evening out and coming down end of last year and beginning of this year. But this last reading, again, spooked the market. We had an uptick in inflation, which many people are again attributing to tariffs. Shelter, which is owner's equivalent rent and home insurance, continues to be the largest contributor, but all of the contributors that you see on your screen, they increase compared to the last reading. The 2.4% reading increased to 2.7% from May to June. We want to look for a trend again. So, we want to keep an eye on this, and hopefully it starts to come back down. But again, as these tariffs get extended and as negotiations continue, we could see this rate tick higher. PCE was 2.4% in May and 2.7% in June. This is the measure that the Fed looks at and excludes the more volatile contributors, food and energy. So this 2.7% is still above the Fed's 2% target, which is why they've kept rates elevated and more restrictive. But as we'll see, they may need to start to flip and look at the other side of their dual mandate, which is the labor market. So labor market seems to be cooling. 73,000 non-farm payroll gains were added in July. This was below 104,000 estimate. Like I said, this one miss alone is cause for concern. The revisions to May and June, though, are what really caught people's attentions and even caused President Trump to fire the Bureau of Labor Statistics commissioner. They were revised down by a total of 258K, which was the largest 2-month revision outside of COVID since 1979. So the revisions bring the 3-month average to 35,000, which is pretty low. The main things that people are pointing to why this may be happening are tariffs and then the immigration reform / policy under the Trump administration. The reason people are pointing that it may be tariffs is because you can see a pullback in manufacturing and trade and transport payrolls. These are the areas of, or the sectors that are most heavily hit whenever import tariffs, are put into place. So we're starting to see weakness there. It's not yet pulling the total job market into recession, but it's obviously having a heavy impact. And then on the other side, I mentioned immigration. Since January, foreign-born work has decreased by 1 million. So those two areas of payrolls are getting hit the hardest because of these new changes. We're also, why you don't see a tick up in the unemployment rate, which is usually kind of the red flag for this sector of the economy, is the run rate for the economy for payroll growth has come down significantly. So basically what this means is we can create fewer jobs without seeing the unemployment rate go up. And that's because as job openings go down, job openings and job demand are both falling. So the numerator and the denominator of this equation are both falling. So you won't see that red flag, but when you look under the hood, you start to see some signs that there could be some cracks. And then obviously if all of this starts to fall, it has a negative impact on GDP growth as well and would not be good for the overall economy. Labor demand, job openings have come down significantly since the peak in March 2022. It shows cooling once again, but it's flattened as of late and not flashing any warning signs. It's just back kind of to this pre-COVID level. So hopefully we see some increases from here. Quits in the top right. The thinking here is a little, at least when I started kind of reading about it, looking into it, it's a little counterintuitive. Usually quits, you think, that's no good. But people normally only quit when they have a better or higher paying job to go to. So as you can see, when quits have been increasing, the economy's been okay. These shaded areas, so 2008 and COVID and the internet bubble, they were decreasing. So, people aren't quitting their job. That means they're not confident they could leave and get another job. They're staying in that job. So usually we'd like to see quits going up to show a healthy economy. And that, again, is kind of flattened out. And then finally, layoffs. They've remained low, but this could be because firms have not been hiring as much. So, since COVID, we had a large, extreme amount of layoffs. I mean, this line goes off the graph. So the thinking is, since that point, companies haven't rehired all the people they've fired, and so they haven't had a need to fire anyone because they haven't overhired. So what we really want to look at is the initial jobless claims report that comes out every week. This should give us a sign, but we haven't seen any increases in that report as of yet, but we'll continue to keep an eye on it. And then Fed rate cuts. So these started in September with that big 50 basis point cut, and then we had another 25 basis point cut in November and December. So over about last year, we've had 100 basis points total in Fed rate cuts. Unfortunately, this has mainly impacted the short end of the curve, while the 10-year remained elevated. But until recently, really. So here, the pink purple line is the 3-month Treasury, which we look at the short end of the curve that Fed cuts directly impact. And then the dark green line is the 10-year Treasury, what we call the longer end of the curve, where if you're going out and borrowing, this is probably closer to the rate that you're going to pay, the interest rate that you're going to pay on your loan. So you can see in September when we got that 50 basis point cut around here, the 10-year shot up, and the 3-month followed the Fed. So the 10 years began coming back down as we continue to get data that suggests the labor market is weakening. Market is coming more in line with the Fed in that respect. So we could see an increase in borrowing and boost in spending and business activity with these lower rates. But if we're in a recession, if the job market is cracking, if sentiment drops, people are already spooked, then low interest rates aren't gonna matter. People's minds are already set, businesses are already set. So it's this balance that the Fed keeps trying to do, and you hear this dual mandate between inflation and the job market, and how they try to get it just right. So something we also look at is rate cut expectations. So a lot of the time, even when the Fed's going to meet and they're going to come out and say, hey, we're going to leave rates the same, we're going to cut, we're going to raise, most of the time we already have a good idea of what they're going to do. Like I said, the market controls or has most control over the long end of the curve. So, when we get these negative reports, you'll see at least negative, growth and negative jobs. We'll see it decline. If we get a high inflation report, we might see it elevate because we know the Fed would want to keep rates elevated. So this is kind of crazy. When a month ago, the percentage chance of a cut in September for that Fed rate meeting was 64%. That was just a month ago. Now it's at 93.4%, mainly because of the inflation reading and the nasty jobs revisions that we just went over. Again, any data that comes out has a heavy impact on these numbers and how they move. I know on July 3rd as well, there was a 41% chance of an October cut, and I believe now it's at 75%. So the market is definitely pricing in more rate cuts than we previously were. This is a graph of the market expectations for the Fed funds rate. So this is basically just what rates people are trading Fed funds futures on, or what they're quoted at. So the market's currently pricing in 2.5 cuts for the rest of the year, all 25 basis points. But unfortunately, both the Fed and the market have been poor predictors of where rates actually end up. But like I said, if anyone knew exactly what was going to happen, they'd be a lot better off and probably wouldn't be worrying about this stuff. But it gives us a good idea of what the market thinks based on how they react to all this different data that comes out. Next, we'll touch on earnings. So S&P 500 earnings, it's been great earnings season so far. I think we're about 80% of the way through. So for this year, it's currently at 10% EPS growth, which is in line with where it was 2024. You can see this breakdown in the top left. So the average from 2001 to 2024 was 7.3%. So we're above that mark by a healthy amount. And you can see revenues are in line. The real difference maker is margins. Like I said, the margins that companies are realizing grew drastically during COVID. People realized they could do more with less, be more efficient, get more done in a shorter amount of time, and it caused margins to grow, which is a great thing. And obviously, with the introduction of AI, I think that's what's boosted it in recent years. The problem that arises is where the EPS is heavily dependent, pretty much 50% of it comes from margin alone. So margins are extremely important and could be at risk as tariffs come into play. If consumers don't feel the impact with higher prices, then these company margins will feel the pain and begin to compress and put downward pressure on these earnings. But for now, they're projected to grow in 2026 and 2027, respectively. Valuations. So on the valuation side, while PE ratios are usually unreliable predictors of short-term returns, as you can see from this dispersion in this left chart, they're all over the place. It gets a lot more tight as a predictor when you look out at longer term periods. Based on a 22.1 forward PE for the S&P 500, we're projecting here that there would be about a 5% annualized return next 5 years, which in a normal year, before these last couple years where the S&P is returning 20-30%, you take 5% a year. That's decent growth. But it's lower than the last few years, and is trend wise has come down, and we could there are other areas of the market where we're projected to see larger returns and even at lower risk at some points, which we'll get into a little later. Looking again, forward PE of the S&P looks extremely overvalued, especially when comparing it to its 30-year average. We're at 22.1 forward PE right now, compared to 17 long-term average. And when you boil it down a little more, looking at the CAPE or Shiller's PE, it's called, this basically just adjusts for inflation. When you look at this, the index overvaluation is even more stark. Index usually sees, you can see when it's above one standard deviation above its average, it's usually followed by pretty stark drop-offs, which obviously means there was a downturn in the overall price of the index. On top of being overvalued, investors are not receiving the yield they usually associate with the index. So the dividend yield last 30 years, the average has been 2.1%, and the latest came in at 1.5%. So you're not really being paid to hold this index in the risk, the inherent risk that comes along with it. And finally, the EY spread. So this basically just takes the earnings yield on the index and subtracts the yield on a medium grade bond. So if it's negative, it basically means that you're earning more by owning a bond than you are by holding the S&P 500. And obviously, usually that's not the case, but right now it is. You're not getting paid or you're not being compensated for the risk that you're taking by owning these equity names. And then diving a little deeper into the S&P, the top 10 companies. So last time that we all got together, the remaining 490 stocks at a PE of 19. That's now up to 20.7. I skipped over the top 10 because it's 139% of the average, and everyone knows that these top 10 companies that you see on CNBC every day, that they're extremely overvalued. But the point here is the remaining 490 stocks have also become they were overvalued at the beginning of the year and have continued to become even more overvalued, now at 131% of their average. This introduces some concentration risk, as you can see on the right. Top 10 market cap makes up 39.2% of the S&P 500 total market cap, and is responsible for 32.5% of the earnings. Like I said, this introduces some concentration risk into the index, especially with most of these top 10 companies being in the tech sector. So it's, when you're investing in an index of 500 companies like the S&P, obviously they're the largest 500 companies, but usually you're hoping to get a little more diversification between sectors, which isn't really the case right now. If we see a pullback in the market, or even just the tech sector itself, the heavy weighting in these stocks will cause a sharp pullback, just due to their overvalued status. If people need cash, if they're worried these are going to be the first stocks that they sell because they know they've gone on a good run. Again, just what I talked about, the risk of concentration. So it's just building on what we looked over. We talked previously about the importance of earnings growth for the S&P and its impact on the market as a whole. Projections show that the Mag 7 earnings will continue to fall. And again, with the impact and weighting that they have on the index, as they fall, it's gonna drag down the index overall. And then the bottom right here is just the performance dispersion. Like I mentioned, last 2 years have been, crazy. Is really the only word I have to describe it. The returns we've seen, which has been great. But then year to date this year, you can see where we have some of the Mag 7 that aren't performing well. I believe this one's probably talking about Tesla. And then even the median performance for the Mag 7 is it's only 3% this year. So you see this that I talked about before. We want to look at trends. Well, this is a line straight down. So if it continues to go that way, and we see these companies start to stumble, it could have very negative effects on the index overall. With that, I want to launch a poll question for you guys. So the poll question, what percentage of the S&P 500's market cap is attributed to NVIDIA? Your options are 4%, 9%, 2%, and 7%. I'll give you guys a little bit to respond there. All right, I'll give 5 more seconds here. All right, let's see. So results, we got 18% for 4%, 18% for 9%, 6% for 2%, and 59% for 7%. Well, NVIDIA is actually, let me hide this. If it goes to the next slide, you guys will see. NVIDIA is actually up to 9%. That looks a little misleading, but as of today, it's 9% of the S&P 500, which is more than 5 different sectors in the index. That's more than consumer staples, energy, utilities, real estate, materials. I also believe if this bar was updated, it's more than industrials and just in line with healthcare. So again, it's great that an American company is the leader in AI technology and this AI revolution, but the effects that are happening in the background, they're not bad right now. But if something were to happen where we lose confidence in the market and things start to crack, it could accelerate any downturn that we see. And then just looking at valuations overall, they look expensive pretty much across the board. So as I mentioned, and we looked at the S&P, whether you look at market cap weighted or equal weight, it's well above its 20-year average at a forward PE ratio. Mid caps have even become slightly overvalued. The only sector of the US equity market that is not overvalued currently is small cap. So, what do we take from this slide? Well, there are other areas of the market that we want to invest in as value investors that are underappreciated, and when things shift and people sell out of these, they're gonna move to where we're already positioned, such as overseas fixed income and other undervalued asset classes. So as I started mentioning, what is everything we went over, what does it mean? So looking at the starting CAPE ratio, what I mentioned before, it's just a PE ratio adjusted for inflation. Ours is currently the S&P's is currently at 38.1, which puts us in this first bucket. So this 3.1% number is what we're projected based on this data. It's what we're projected to earn on the S&P on an annualized basis for the next 10 years, which is well below, it's not a good sign for forward returns from the S&P and well below a lot of the projections that we're seeing for returns for other areas of the market. On the credit side, yield spreads remain tight. So this is just looking at a spread is the difference in yield between a junk bond, mainly, you hear them as high yield, and treasury bonds, which are, less, almost zero risk. High yield spreads will widen during times of panic and increased volatility. So you'll see 2008, COVID. Again, this was a one-day shock on Liberation Day, but you still saw them widen out a little bit, still below that 5.25 average, and we're well below that right now. So basically, what this means is the yield differential between a super risky bond and a almost risk-free bond is minimal. And when that happens, you're not getting, again, just like I said with the dividend yield on the S&P 500, you're not getting compensated for the risk that you're taking. So, why take that risk if you can earn a comparable risk-adjusted yield on something like a treasury? And then again, we're what I just mentioned, yields, the spread is currently at a 2.86, which puts us in this first bucket, below 3.6, tightest 20% of high yield spreads over the last, 30, almost 30 years. What does this mean? Based on this data, it means that the S&P annualized for the next 5 years will return 2.9%, which is pretty close to that last one where we looked at CAPE ratios were suggested at 3.1%. So, let's average it out and say a 3% return for the S&P 500. So obviously, it's just another indicator that we look at that's showing that, yes, AI has been great, growth has been great, the U.S. has been leading the charge, but there's reversion to the mean, things become overvalued to a point, and when that happens, the reversion to the mean usually comes down, and then it'll stay there for a little bit of time to kind of level things out. And then just another chart showing another kind of undervalued asset class, and it's what I mentioned on those comparisons to the long-term PE, where small cap was the only one that was slightly undervalued. This shows large cap versus small cap. So basically, anything over 1 is showing that large cap has drastically outperformed small cap. This is on a relative basis, it's at its highest level since October 1999, and so it's just basically showing that large cap has gone on a run compared to small cap, and that last time this happened, I'm not predicting anything, not saying that this is going to happen, but it's kind of weird when you look at all these charts. There's a lot of it. You used to hear a lot of 1998, 1999, early 2000, right before, the internet bubble and what happened. So it's just, again, we're not predicting anything, but it's just things we want to look at and keep in mind and dig under the surface and invest in areas of the market that aren't overvalued, so that when things flip, we'll be a little bit more protected from those downturns. Same thing here, value versus growth. So like that large versus small, and again, not funny because internet bubble was a tough time. We don't want that to happen, but again, growth has outperformed value on a relative basis, and it's gotten to a level that we haven't seen before, since it's actually surpassed 2000. So as value investors, these are just, value versus growth, small versus large. These are all decisions that Ironwood has to make and looks at across the market. And then comparatively, just investing overseas. So this slide surprises most people. I know when I first looked at it, I was also surprised. So since October 2022, it's showing the performance of Europe, this green line, Japan, blue, and S&P minus NVIDIA, is the gray. So again, it just shows how much of an because if you included NVIDIA, this US line would be above the others. So it just shows that, again, if you take out one, that's not even the top 10 companies. You take out one company, and you have underperformance compared to these other parts of the market. So if something happens, there's a lot of, we saw that the DeepSeek, a Chinese company, said they could make, they made an AI that could produce results with 100% accuracy, 10 times quicker, 10 times less cost than NVIDIA, and the stock dropped. That could happen, it ended up not being correct, but that could happen at any day, and it could have extreme adverse effects on markets overall and on the U.S. market. And then looking at valuations like we did within the U.S., if we look overseas, a couple of these have started to creep above their long run average and where they were at the beginning of the year. But when you compare it to the U.S., these areas are still undervalued. So we definitely want to look at opportunities in these countries as well. And then just continuing that point, this is looking at emerging markets. So it just shows that it's cyclical. You have areas where EM outperforms, US outperforms, goes back and forth. It was a record low around the last time we spoke, where the US had been outperforming EM from 2011 to 2024. But year to date, EM is up 18.22%, while the S&P is only up 7.91%. So while it's only been 8 months, we may start to see a trend where EM takes that lead back and outperforms for an extended amount of time. And then same thing, just yields, like we mentioned before, for fixed income, extremely high yields across the board. But like we mentioned, you can get high yields while investing in treasuries and in corporates and MBS. These debt, the debt that has a little punch behind it, that's backed by something. Whereas these, when you get over here, the high yield and the leveraged loans, there's a lot more risk in there. So in our fixed income portfolio, we want it to be safe. That's the main goal of our fixed income allocation. So we'll happily clip coupons and take these yields while we do so. And then just another chart, I know they're not the most exciting charts, but this basically just says we have a current yield on the Bloomberg Ag, which is the aggregate bond index, of 4.48%. This implies that over the next 5 years, we'll get a 4.52% return on the index. So again, 4.52 doesn't jump off the page, but when we remember the S&P projected returns of around 3%, then bonds look extremely attractive, especially when we look at a risk adjusted basis. And then past is the past. I know you guys are probably sick of seeing this slide, but Vanguard updates it monthly, so we keep an eye on these. Again, just looking at asset class annualized returns, the light green is last 10 years, and then the dark green is next 10. So all the data that we just looked at supports everything you're seeing here. The U.S. markets are overvalued, and then outside, overseas, and bonds are undervalued and have a chance at possible outperformance over the next 10 years when comparing returns to domestic stocks. And then this is a slide. It looks pretty simple, and it is, and it's something I mentioned before. So they call it a not so great convergence. This is just showing that it's showing the gap between the highest and lowest yielding major U.S. asset classes. So normally you'd want equities to be yielding more than bonds because you're taking on that inherent risk, right? The 5 things that this gap looks at is the Bank of America U.S. Corporate Bond Index, the 30-year Treasury bond, the forward earnings yield on the S&P, 3-month Treasury bill, and 10-year Treasury bond yield. The highest of those yields is the Bank of America U.S. Corporate Bond Index at 494, and the lowest of those yields is the 10-year Treasury bond index at 4.22. So it's a 72 basis point gap. It's come down even lower from when this chart was made. It's probably right here. A 72 basis point gap between the highest and lowest yielding security. And the S&P isn't even the highest yielding one, which should be the case because it's the most risky. So again, this just supports our case that right now you're not getting paid to take on risk in the equity market. And then this just a good slide showing a majority of the time, if you've got a long time horizon, anything over a year, you're probably better off investing in a 60-40 portfolio, risk versus safe than cash. Short term, probably want to invest in, a short-term T-bill or money market because you'll need that cash and don't want to make any sells. But if you can hold for longer term periods, the percent chance that you're going to outperform cash is pretty high, up above 80 and up to 90 and 100% on a 15-year time horizon. And then also, just in tandem with that, you want to make sure you have time and you're diversified. As you can see, the 1-year distribution, you don't want to have 10K and then need 10K in a year and invest it completely in stocks, because there's a chance you would lose 37% of that and not have enough money to meet your funding needs. So that's why you work with your advisor to build out a plan on cash needs. How long will you need this? Because then that gives them the tools they need to decide, okay, how much of the portfolio do we want to invest? How much cash do we need to put to the side? And how much, can we get in that portfolio and truly diversify? And then price of admission. So just shows growth of $10,000 adjusted for inflation from 1994 to 2024. As you can see, cash lost because of the inflation, but bonds more than doubled. And then obviously small cap stocks and large cap stocks, you're getting what you pay for. Unlike right now, like I've said over this presentation, in the long run, you get paid for taking on the risk that is attributed to equities. And then this is something that we just kind of look at every webinar to show, it's impossible to predict which asset class is going to be the top performer within any year. Colors are all over the place. You can see that the asset allocation, which is a 60-40, is kind of steady Eddie compared to some of the other ones, but it's difficult to predict which asset class is going to outperform. So the best thing we can do is make sure that you're properly diversified across most, if not all of these. And then finally, I just wanted to wrap it up. What is Ironwood doing? How are our portfolios constructed? How does everything I just went over, how do we put pen to paper? We came out with a series of 6 blog posts where we kind of go into, the science behind portfolio construction and rebalancing and how we do what we do. So if you go to the Ironwood website, you scroll to this, kind of hover over this resources tab, this will pop up and you can just click on blogs, and then this will be a list, all 6 of these blogs. Kind of if you want more detail about, method behind the madness, that's where you can go. And with that, I'll snap it back over to Preston and we can answer some questions.
Yeah, we have a couple. The first question is going to be, Do you believe Trump's interference with the market will have negative consequences? He did fire that labor chair, and he'll pick up a new Fed chair next year.
Yeah, so without getting, it's hard to not get political right now in this environment, especially with how much attention the administration is putting on it. The firing of the Bureau of Labor Statistics commissioner, the administration said, oh, they didn't revise jobs down until after the election last year, and it's come out, and that's been proven false. They revised the numbers down right before the election. He complains that Powell should be cutting rates, but he's the one that hired Powell. So, short answer, right now I wouldn't be worried about it. I don't think it would bring it into question too much. At the end of the day, there's still, a chain of command, and there's groups making all of these decisions and putting out all this data, whether it's the whole Bureau of Labor Statistics or whether it's the Fed. We have multiple Fed governors that come out. We had two that for first time in a long time dissented with the opinion to hold rates steady. So there's still a system of checks and balances as of this point. Good question.
And then next question is why has international outperformed the U.S. by so much? And do you think this will continue?
I'm going to start by saying, nobody knows if it's going to continue outperforming. I can talk to why it has been outperforming and why the continuations of these trends obviously might help it continue to outperform. The main one is the dollar. We've seen a sharp pullback in the value of the dollar compared to international currencies this year, which has helped international stocks and a lot because, well, one, the companies are starting to provide better earnings and become more healthy, and they're getting a little bit of a boost from their quote unquote Fed chairs, because a lot of them are lowering rates. They're putting money in the pockets of consumers, so their economies are starting to grow a little bit with rates coming down. So Europe is kind of having that catch up that we saw after COVID. They're just having a little bit delayed. So their economies are not only being bolstered internally, but with the decrease in the level of the dollar that we're seeing over here, that automatically kind of boosts those returns even higher. And then I believe so again, a lot of cyclicality in all this stuff. But if you could draw a picture, or if I had a line here that showed the movement of the dollar, you'd see that a lot of the time when the dollar is elevated, this is exactly what it's showing. Periods of declining dollar, international outperformance. So you kind of track this line, and then if the dollar rose, you would have international underperformance. So up until this year, from 2012 until the end of 2024, the U.S. stocks and the U.S. dollar went on an unbelievable run, especially when compared to international stocks and currencies. But so far, year to date, we've seen that flip. And as long as the dollar continues to not deteriorate, but it went on such a run that it's now coming, again, that reversion back to the mean. As that occurs, it'll just give an even bigger boost to international outperformance. So as long as we continue to see that trend, I would think that international would continue to outperform.
Thanks, Rex. And that's all the questions we had for today.
Cool. Thank you. Well, thank you, Preston. Thank you guys for joining us. Again, taking time out of your busy day. I hope you guys enjoy the rest of what's left of summer and the rest of the year. Thank you, everyone.